Hey everyone, welcome back to the channel. So I know the market is real scary. We just finished the first half of the year and it's like record down year. However, not everything is crashing like crazy. If you're the wrong stuff, it feels like it's a crazy crash. But if you've been hanging out on this channel, I've been telling you guys be in cash and be in some dividend stocks and you'll be okay. Also too, if you're new here, my name is Chris, a professor for about 10 years. And this will help you grow your account and grow your mind. So let's take a look at this. You can see the S&P is down 21% year to date. And then we can check out the NASDAQ is also down 30% year to date, actually. Now, I know a lot of people out there might be in stuff that's like down really a lot more than the market. That's just how it goes. You know, when you in a high beta stock, it'll go a multiple of, what the market is doing. I just want to point out that not everything is crashing. Lockheed Martin has had a pretty decent year, year to date up 20%. So it's totally fine. And Archer Daniels Midland is another one I've been talking about. So food stocks, weapon stocks, doing totally fine. And then something like a Procter & Gamble, your toothpaste stock. Not all the stocks that we talk about on the channel have been doing great, but Archer Daniels is still fine. It's basically flat when you count the dividend. It's totally fine. And probably people will be piling into this thing, these kind of stocks. Other stocks that we've talked about as well, something like Verizon year to date. It's down, but these things are basically flat because it's got like a 5% yield. So, I don't want you to think that everything is crashing. It's not really the case. One of the problems with our way our market is constructed these days, at least the S&P and the NASDAQ, et cetera, S&P is way overweight tech. I've mentioned this before in other videos, and that's why it may seem like everything's crashing. It's just because like Apple, Microsoft, Facebook, these things that just take up a large part of our market, Google as well. And it weighs very, very heavily when they're down. And unfortunately, for those of you in tech, it's kind of the place you don't want to be in a rising interest rate environment. I've mentioned this to you guys before. Also, too, going into the more details, consumer spending is down. I was reading about like people are going out to restaurants less. Big ticket items aren't really purchased so much. One of the things I was thinking about, I remember when like Best Buy had their earnings report, and I think they were saying like basically people bought a whole bunch of TVs and stuff during the pandemic, right? Because we're all at home watching Netflix. And then moving forward, we don't need a new TV every year, right? So it's going to be hard for retail sort of stores and stuff to post, great year-over-year earnings reports, right? So it would be the same with any kind of thing like home improvement stuff. Now, home improvement things are an interesting one. Usually people aren't changing houses and they're going to Lowe's and to fix up their homes and stuff. But you have the same situation, like say when Restoration Hardware reported that, their forecast doesn't look so good either. I think it's people already moved during the pandemic, bought their furniture, bought their TVs, and then moving forward with going into the recession, people just aren't going to be spending that much. Prices are too expensive as well, which is kind of crazy, but that's the whole idea. When you raise interest rates, it lowers the demand because basically things cost too much, right? So we don't want to spend any more money, and then eventually prices will come down. That's the idea, at least. If you take a look at this is the market, the last since 1970, and so we were down. We looked at it here as like 20% or something like that, 21%. And then 1970 is the last time that we've seen this much. But you can see there are other years when we were down. Actually, I can pull my arrow up. Just give me a second here. Let me grab my arrow. Where's my arrow? There it is. So you can see we were down there, and we were down 1970 as well. Now, the market wasn't so great in the 1970s. You had the oil problem. You also had stagflation. So the basic gist was high unemployment, low growth, high inflation. And it's hard to fix because essentially you want to raise interest rates, but then it kind of stunts growth. That's sort of what the deal is. So that's where the Fed's got to be careful with how they raise interest rates. Also, too, if you saw the video I made before, sort of like one of the things that we're going to need to solve our inflation problem is actually unemployment. So you're looking at like 1 year of 10% unemployment, maybe 5 years of 5% unemployment, something of that nature. So it's going to be around there. And we'll see. That's why I started making jobs about recession and jobs. Started making videos about recession and jobs because a lot of people are going to get laid off and start looking for a new job. And, one of the things that if you want to do well in the market is all about anticipation. So that's why been telling you guys all along, you don't want to be in tech. You want to be in dividend stocks. And I mentioned the food and defense stocks as well. Energy is an interesting one. That's a wild card. Energy has been good. Assuming that we reopen and the demand is there, energy probably will be good, but it's hard to say. It's been really, really volatile, energy, but I think I don't know. I never know what to make what OPEC is doing, to be honest. But I do know in the long term, we're still going to need energy. And I think if I were in a growth stock, if I were looking at growth stocks, I'd be looking at alternative energy myself. One of the things that was sort of a downer today was Micron had their earnings report. So Micron's one of the chip companies or factories, what do you want to call it? Go say company. And the basic gist of it is they're saying that there's going to be less demand. And so chips are important to the stock market understanding because they represent both consumer and also tech as a whole. So like, for example, if chips don't need to be used in, say, data centers or in kind of B2B kind of things, cloud computing, that doesn't bode well for, tech. And also, too, if chips aren't going to be in cell phones and stuff like that, they're just basically saying their orders are down. Taiwan Semi also were saying that they expect less orders in the future as well. So this is going to be a thing. It's interesting because I remember we went from where the chips companies were suffering from shortages, so they couldn't, sell that much thing. Now we're suffering from demand. So we have demand problem and sort of supply chain shortage problems at the same time. It's slowing down. We're most likely in a recession right now. The other issue as well, like I said, the bad news hits. The bad news hits will keep on coming. So Facebook's an interesting one. It might be a value trap stock because when you look at Facebook, you take a look at the P of this thing or Meta. What's the P of this thing? Now, why is it giving me? It does this weird stuff. There it is. I keep typing FB. So look at this. The P ratio is like really low in this thing, 12, right? But, it may end up being a value trap because this is sort of based on its prior estimates of earnings. And if the earnings are coming down and also, too, Facebook isn't growing anymore, this could come down more. Who knows? To be fair, though, this is a low multiple. I'm not crazy about it because it doesn't have a dividend, but it is a low multiple, much lower than it was before. And they're going to have to convince us that they're growing. The other issue is that they're spending a ton of money for that metaverse stuff, which I'm not so keen on. I think other people have different opinions on that, but, we'll see. This is the quote from Facebook. The company must prioritize more ruthlessly. I don't know what it means to be ruthless, but I think that means they're going to be firing people and stuff like that because they say operate leaner, that's firing people. Meaner, that means work hard with people who are still there. And better executing. And then here's the other bit. This is from the chief product officer at Facebook or Meta. I have to underscore that we are in serious times and headwinds are fierce. We need to execute flawlessly in an environment of slower growth where teams should not expect vast influxes of new engineers and budgets. So they're not going to be spending tons of money. They're not going to be developing tons of stuff. And it's like, can't just be throwing money at a problem. They're not hiring people. So that means the current people are going to have to work hard. And the other thing as well is with the change in the Apple policy of like sort of the privacy issues or the revenue sharing because Apple's like kind of changed the policy of how Facebook would make money on that. And it wasn't just Facebook, it was all apps on Apple. Also too, the ad rates for Facebook, I keep on Facebook, whatever, for Facebook and Google are going down. Because essentially there's less demand to advertise these platforms. So you may see revenue hits on these companies. Now, to be fair, this is a real company. They have cash, they're spending the cash, but they're not like a fake company. They're a real company. But it is a problem with our big tech companies are projecting slowdowns and tough headwinds. So we'll see on that. Who knows? Anyone's guess. And I'll be curious if you guys are into Meta or not. It appears to be a value trap because they don't have a dividend, but it is definitely cheaper than what it was, and you're not buying at the top. Because one of the things is, this is also true. This is the projected estimate for quarter two is negative 1.5 GDP. We already had negative 1.6 GDP in quarter one. So most likely we're in a recession right now. It's officially going to be a recession. Theoretically, this is the bottom. I tend to think that we have more downside, but even if, let's say, now is the bottom, say for example. It's not going to be like a slingshot back up to the top. It's just not going to be like that because there's not enough good news that are going to be coming out. The only thing that would really, really help the markets, or not the only thing, but one thing that would really, really help the markets is probably the end of the war in Ukraine, but I just don't see that happening anytime soon. I just don't know. And the other issue is too is you still have a threat of COVID, which I think we're done with it here. I don't know. I don't think the monkeypox is serious, but we're looking for that, and we're just looking for inflation to come down. So gas prices come down, and price of everything come down, and supply chains ease. So we're still a little bit of ways, but to be fair, it looks very, very bleak right now. You could argue it's the bottom. I don't think so, which we'll get into in a second. I was going to show you this. Because you're starting to see stuff like this as well. So not only are we talking about companies sort of like having money issues, if you guys are a sports fan, especially college sports, UCLA and USC are like going to leave the Pac-12, or which I grew up with the Pac-10. That's all your West Coast, universities, and they're going to go to the Big 12, or actually, sorry, Big 10. It's the Big 12 now. It's like 12 teams in the Big 10. But the Big 10 traditionally was like your Michigan, Wisconsin, Ohio State, Michigan State, Indiana, Illinois. Who else is in the Big 10? I think Purdue's in the Big 10, and I might have left out one, but that's the Big 10. All the Midwest schools, and Penn State as well. And then recently the Big 10 like added, I think, like Nebraska and Oklahoma in that thing. No. This Nebraska and like another one. I can't keep track because the SEC, if you're in the sports, I think Oklahoma and Texas are leaving to go to the SEC, the Southeast Conference. And then it's weird for UCLA and USC to go to the Big 10. I don't know what's going on. I just think this is all about money. And that's why I mentioned the thing with like the Facebook stuff. This is all related. Like there's less money to go around these days. And so, we were talking about, say, how companies would buy up other companies. But now we're talking about how like sports conferences in college are like buying up sports teams to like consolidate money. It's kind of ridiculous. I don't like it, to be honest. I do like tradition in college sports, but these days it's all about money. So it is what it is. I'll be curious if you guys are into this stuff and what you think about UCLA and USC leaving the Pac-12. It's crazy. I don't know what's going on in this world. Okay, so the Shiller PE is currently trading at 29. We started tracking this when this was around 40 something, and the high it's ever been was 44. And I was telling you guys for a long time the market was most likely going to pull back because we're trading at high multiples. This is adjusted for inflation, and it looks like I was right. And it's not hard to see. You guys can read numbers. Okay, so the mean and the median are around mid-teens, right? So if we're going to go to historic levels, theoretically, we go down by another half. Theoretically, no one has the answer to that, but you could argue that we're going to be like that kind of that's our trend line. So you could argue. I keep saying mid-20s. Even 20, you could argue, but we're going to keep an eye on this. We're still a little bit high. Now, this is the market as a whole. And remember, our market is tech heavy these days. So we're going to see how this shapes out. But Shiller P is still trading a little bit high. Fear and greed is not so great either. People are afraid, but not very afraid. Very afraid will be when this gets single digits. And it has a few times, but usually that's the time to be buying theoretically. I always say theoretically because I'm still bearish, but I want to show you some other things. Okay, so this is Apple. Apple's trading at a 22 PE. Now, if you don't understand what this means, this is a price to earnings multiple. So basically, the price of the stock in relationship to how much a company earns, okay? Apple's currently trading at 22. Is that good or bad? Well, it depends. So first is the way you think about this is Apple going to be growing, say, 25, 30% in the next year or so. If you think yes, then Apple's now at buy levels, if you think yes. If you think no, Apple's not going to be growing, and remember our GDP is in a negative growth, so, it may not be growing. The other thing is, too, historically, this is Apple's traded at like a 10 multiple back in 2016. I think Apple's a different company than it was back then. But just to give you some historical perspective, right? Apple generally used to trade in the mid-teens. And then it was probably right around, where is this? 2019 started to go the high teens. 2020, you had it at 25. So we're actually below the peak of 2020. And then the bottom of the pandemic, Apple traded at 19. So this is a good way to track whether or not you're getting a good deal on the stock, is think about the sort of historical multiple that you've paid. And this gives you a good sense of like, okay, what does the market usually value a company at? Basically, for the multiple to come down further, if it's going to get into the teens, either the price of stock has to come down or earnings have to go up. I don't think earnings are going to go up. So if earnings drop at Apple, then the P multiple, assuming the price of the stock is the same, but the earnings go down, then that raises the P, right? So it's either the price of stock comes down or the earnings go up, and either one of those things. That's how you think about these things, right? And you can see it's a math formula, right? The P over the E. So you need the P to get smaller or the E to get bigger, basically, to get a better multiple. And I would say if Apple ever gets to mid-teens, that'd be a good time to get in. But you could make the case we're at the bottom now. You could totally make that case. I honestly don't know. I'm just giving you an idea of like what to look for. It's hard to know, where the bottom of the market is right now. I will say though that my opinion is when this whole crypto thing basically goes to zero, that's the bottom. We're getting close to that though. So this guy, the FTX dude, Sam Bankman-Fried, he's buying BlockFi supposedly for 25 million. However, it's really interesting because the previous valuation of BlockFi was $1 billion. So it's like from $1 billion to 25 million. So basically almost zero, the valuation. And then basically the CEO of BlockFi is like, hey, everyone, lots of market rumors out there. I can 100% confirm we aren't being sold for 25 million. I encourage everyone to trust only details that you hear directly from BlockFi. So if I had to guess, they're going to be sold for 25.5 million. But according to him, he's got a lot of pride and stuff like that. So we'll see. I'm sure they're going to negotiate to get some more money. And, regarding the world of crypto, there's going to be a lot of lawsuits. There's going to be a lot of frozen accounts, and it's going to be really ugly if things aren't already ugly now. So I'm not really into this stuff. So my money is not frozen in these things, but I'd be really scared if I had my money frozen in these kind of companies. I would be really scared, to be really frank. And this is very much like an 08, 09 kind of thing. So that's what's going on in the markets. Hopefully this is helpful for you. I know I ramble on with this stuff. But I just want to keep you informed and sort of things to think about what's going on and see how everyone's feeling. It is true, though, when people are feeling bad, it's time to be buying, but that's why it's hard to buy, because it's never fun to lose money. I mean, I get it. Because people always ask, what should I do? Should I get stocks or not? I'll just always say the same thing. Well, at least you're not buying at the top. Also stick with blue chippers and companies you really believe are going to come back. Companies that are unprofitable, and who don't have a competitive moat, meaning that they don't have something that protects their business to where like they can just beat all their competitors, I would stay away from. Also, too, my preference would be companies that are essential. So your food, your defense stocks, dividend stocks as well, and companies that have survived through recessions before. That's why I was saying like we're still going to buy toothpaste. I'll use a toothpaste example. So toothpaste stocks is kind of where you want to go. To be fair, though, those are going to be a little bit expensive because everyone's going to be rolling into those things or already have. So you can kind of mix it up, get your value tech where you can find it, and get your dividend stocks, the ones that you like. So thanks again for watching. I hope this is helpful for you, and I'll catch you in the next video.